Well, good afternoon, everyone. Thanks for joining us. I wanted to welcome everybody. I appreciate you taking the time out of your day to spend some time with us. We're going to start off the day talking about some individual tax planning items. We have a robust group, so we're going to keep moving straight through the presentation. We'll talk about individual tax provisions first, followed by business tax matters. So with individual tax financial planning, I'm going to start off with some general comments around planning in this kind of unique political and economic environment, followed by Chris DeBlanc. Next slide, Jen. Chris DeBlanc will follow up talking a little bit about some changes and some retirement investment planning opportunities under new legislation under the Secure Act, as well as the CARES Act, as well as some other topical changes impacting on 2020. After Chris is done, he'll turn it over to Amanda Wilhelm, a principal in our group, who will spend some time on other family tax matters, income tax, and estate planning matters. At the end of Amanda's presentation, if we have a few minutes in our section of the presentation, we'll take some questions. As Jen said, if you don't hear from us during the presentation, you can expect an email following today's program. We do, so unless you've been sort of sheltering in place and watching nothing but Netflix for the last couple of months, everybody's aware that there are significant prospects for substantial tax law changes forthcoming, and there's a great deal of speculation about that in the media. So with the transition of the presidency to Democratic control, the Democrats maintaining control in the House of Representatives, and the possibility or the prospects of potential shift, which won't be known until after January 5th's runoff elections in Georgia. The Senate control is unknown. So certainty around tax planning for 2020 is likely not a luxury that we have available to us. So while Biden campaigned on a platform of substantial tax increases, especially on higher income taxpayers, his ability to implement that change won't be known until January. And frankly, even if the Democrats do take control of the Senate, sort of the pace and magnitude of any such changes it may or may not be as quick and dramatic as what some might think. We have to remember that the economy is still in a pretty fragile state, still in recovery mode. And I would imagine that some moderates are going to have trouble supporting sweeping change that might derail that recovery. In fact, we might see that moderate legislators on both sides of the aisle could have significant impact on the shape of future tax legislation. Also, it seems likely that any changes in the tax law might come in more piecemeal fashion, because it seems like the Democrats have many items on their agenda, whether it be infrastructure, healthcare, environmental regulation, that will require funding. And as they attack each one of those separate items, they may choose to try to fund that with piecemeal legislation. So while we do have 2 slides in our deck that we're not going to spend time in detail reviewing the Biden tax proposal because it is speculative, and this will be in the deck that is sent out to you after today's program, so you can review it at that point in time. But I would just leave it that what approach each individual taxpayer needs to think about is really highly dependent on their own personal situation. We'll recommend that you consult with your SC&H advisor about your personal situation to determine whether taxable income acceleration or deferral is most appropriate in your personal circumstance. And that's going to be based not only on your current tax posture, but also your expectations for income in coming years, alongside the prospects for potential tax increases down the road. So with that, I'm going to turn it over to Chris DeBlanc to talk a little bit about retirement planning provisions.
All right. Well, good afternoon, everyone. My name is Chris DeBlanc. I'm a financial advisor with SC&H, and today I'm going to be talking about some year-end financial planning opportunities. First, I'm going to be covering some retirement planning opportunities with the Secure Act and the CARES Act. The Secure Act made two significant changes to retirement. First, it eliminated the IRA age limitation. So prior to the Secure Act, you couldn't make a contribution to an IRA after age 70 and a half. Now, as long as you have earned income, you can make that contribution. There's no age restriction. So if you're in your 70s and you have earned income, consider making an additional contribution. Second, the Secure Act changed the age for required minimum distributions from 70 and a half to 72. So this will give you an extra 1.5 years to leave your 401k or IRA invested. So if you don't need the money, don't take it, let it continue to grow and continue to defer the tax. This also gives you additional time to make a conversion to a Roth IRA and convert some of that tax deferred money to tax-free money. And we'll cover that later in more detail. Next slide. All right, so now retirement planning under the CARES Act. Well, the CARES Act also created two opportunities. First was the suspension of all 2020 RMDs. So if you didn't need your RMD, hopefully you didn't take it. If you did take it, at this point, I think you're stuck with it. There was a window of time when you could have returned that money, but that window's closed. So the next thing that the CARES Act did was it created the coronavirus-related distribution, or CRD. Now, this allows you to take a distribution of up to $100,000 from a qualified account, not be subject to the 10% early withdrawal penalty if you're under 59 and a half. And then you can elect to spread the taxability of that income over the next 3 years. And then in year 3, you have the option to return that money and not be subject to any tax. Now, there's an opportunity here to recharacterize your 2020 normal distribution to a coronavirus-related distribution, and then elect to spread that income over the next 3 years. Now, what this can do is it can allow you to move down to a lower tax bracket, allowing you to pay less in total taxes. Now, if you're going to be in a higher tax bracket in the next 2 years, then you may not want to make this election. So you need to do a little bit of tax planning to make sure that this approach makes sense. Also, next slide, please. You have to qualify for the CRD. And so you have to meet one of 5 requirements. You've been diagnosed with COVID-19 by a CDC test. You have a spouse or dependent that's been diagnosed. You've had adverse financial consequences as a result of being quarantined, furloughed, laid off, having work hours reduced, lack of child care that caused financial consequences. And then you experience adverse financial consequences as a result of the closing or reducing hours of a business that you own or operate due to COVID. Now, if you meet one of these 5 requirements, and I think many of you do, you can qualify to make the coronavirus-related distribution. Now, notice that last bullet point is underlined. I think this criterion is broad enough to qualify most of you for the CRD. Notice it says adverse financial consequences as a result of the closing or reducing hours of a business that you own. Now, ownership in a company can be represented by stock. How many of you own stock? Well, probably quite a few of you. Did your stock decline in value due to COVID? Well, the stock market fell 30% due to closings, so I would say it's a strong possibility. Did you realize capital losses from the sale of any stock, or did the companies that you own stock in reduce or suspend their dividends? These would be considered adverse financial consequences due to COVID. So if you qualify and you took a normal distribution from your IRA or 401k, consider converting that distribution from normal to CRD, and then you can elect to spread that income tax hit over the next 3 years. Okay, next slide. Onto employer retirement plans. This is pretty basic stuff here, but just make sure that you're utilizing your employer's retirement plan to its fullest potential. And that means maxing out what you're allowed to contribute before year end. So for most of you with 401ks and 403bs, the max you can contribute is $19,500 or $26,000 if you're over age 50. And if you don't have the means to contribute the maximum, just make sure that you're contributing enough before the year end to get the full employer match if your employer offers one. Otherwise, you're just leaving money on the table. Next, we're looking at simple IRAs. If you have one of these, the max you can contribute is, go back to the other slide, please. Previous slide, there you go. Simple IRAs, the max you can contribute is $13,500 or $16,500 if you're over 50. These need to be funded by the due date of the return. And then if you're self-employed with a SEP IRA, you can contribute approximately 20% of your net business income. And that can be funded by the due date of the return as well. And if you're self-employed and you don't have a retirement plan for your business, SC&H advisors can help you get set up with a plan, and we can also help you manage those investments for you. So if that's something you're interested in, please reach out to us. We're here to help. Okay, next slide. On to individual retirement accounts. So with these, the max you can contribute is $6,000 or $7,000 if you're over 50. This needs to be funded by the due date of the return. So even after year end, you've got some time. This is for traditional IRAs, non-deductible IRAs, and Roth IRAs. Now, there are income limitations on each one of these accounts. So for a traditional IRA, there's no income limit if you're not covered by an employer plan. But if you are covered by a plan, then your contributions start to fade, the deductibility of your contributions start to phase out once your income is 65 for single or 104 if you're married. And then once you've earned more than 75,000 for single and 124,000 for married, you can no longer make tax deductible IRA contributions, but you can still make non-deductible IRA contributions. Anyone with earned income can do that, and there's no income restriction. Roth IRAs do have an income limitation. So if you're single making less than 124,000 or married making less than 196, you can contribute the full amount to a Roth. Once your income goes above that, the amount that you're allowed to contribute gets reduced. And then once your income's over 139,000 for single or 206,000 for married, you can no longer make Roth IRA contributions. Now, there is a trick to getting around the Roth IRA income limitation, and that's the backdoor Roth contribution. So next slide, please. So to execute this strategy, you first make a contribution to a non-deductible IRA, and then the next day you convert that to a Roth IRA. You didn't receive a tax deduction for that original contribution, so when you convert it to a Roth, the conversion amount's all basis, and so there's no tax due. It's a pretty simple strategy to execute, but it gets a little complicated if you have other tax-deferred retirement money sitting in IRAs. If that's the case, then the IRS's pro rata rules kick in, and some of that Roth conversion can become taxable, which kind of negates the benefits of that strategy. So you need to watch out for that or plan for it. So perhaps before doing the backdoor Roth, consider just a Roth conversion of any tax-deferred retirement accounts. So in a Roth conversion, you convert your 401k or your traditional IRA pre-tax assets to an after-tax Roth IRA. You pay the ordinary income tax on the amount that you convert, and now you have a bucket of money in retirement that's no longer subject to income taxes or required minimum distributions. Next slide. Okay, so when you're doing this, you want to be cautious of your tax brackets because your taxable income is going to get increased by the amount that you convert in the year of conversion. So converting too much to a Roth can push you into a higher tax bracket, causing you to pay more tax. So it may be beneficial to spread that conversion amount over several years in order to reduce your tax rate. Now, if you're interested in this, please reach out to us. We can help project the income tax liability and determine the optimal amount to convert. Okay, next slide. One more strategy I want to speak about with respect to IRAs, and that's Roth IRAs for kids. There's no age restriction when it comes to who can use a Roth IRA. There's only income restrictions. So you just need earned income below a certain threshold. The contribution amount is the lesser of $6,000 or the amount of the earned income. And so this presents an opportunity for business owners with children. You can put your kids to work in your business, put them on the payroll, and shift tax-free wealth to that next generation. So here's an example. Suppose you hire your 5-year-old to sweep the floors in your business, take out the trash in the office, clean the office, perform various other tasks that a 5-year-old could effectively execute. Your business pays the kid $6,000 for his services. The business gets to deduct that salary. So you as the business owner reduce your taxable income. The kid gets $6,000 of taxable earned income, but since that's below the standard deduction, the kid pays no income tax on those earnings. but now he has enough earned income to contribute the maximum amount of $6,000 to that Roth IRA. So as a parent, you help the kids set up that account and you help him make that Roth contribution. And now your child has a bucket of money, tax-free money, that's going to be able to grow for the next 60 to 90 years. I mean, that equates to a tremendous amount of money in the future. Additionally, since it's a Roth IRA, Roth IRAs have a little bit more flexibility than other retirement accounts, so your child can use that money for college in addition to retirement. So if you have the opportunity to do that and the resources, it's a powerful tool in creating tax-free wealth for your children. And if you need help executing this, please reach out to us. We can help with that too. Okay, moving on to our first polling question. What is the highest, or what was the highest individual income tax rate in US history? And we will give you about 10 seconds to answer that and click submit. Is it 37%, 39.6%, 70%, or 94%? And Jen, I will let you decide when to close that poll. It doesn't matter if you're right, just select the answer. Okay, I think that's enough time. What do we got? Well, the correct answer was 94%, which is shocking. That was back in 1944. We've come a long way since then. Today we're sitting at 37%. So what do you think rates are going to do in the future? I personally suspect they're moving higher. If you were to ask President-elect Joe Biden, I think he would also suspect they're moving higher. Okay, moving on, next slide. We're moving on to investment planning. So let's talk a little bit about asset allocation and portfolio rebalancing. So your asset allocation is your portfolio's mix between asset classes. And so that's what percentage your portfolio is comprised of: cash, bonds, equities, real estate, and commodities. Now this allocation, this mix, accounts for about 90% of your portfolio's rate of return. So having the correct allocation that meets your goals and objectives, it's extraordinarily important. And once you have that allocation in place, market fluctuations can push the allocation out of balance. And over time, this can negatively impact your investment's objectives. So rebalancing on an annual basis realigns the portfolio to your financial plan and your investment strategy. Now, if you haven't done this yet, doing it before year end might be a good time to do it. Now, as an investor, we want to buy when the price is low and we want to sell when the price is high. Now, that's easier said than done because no one can effectively and consistently time the market that way with any accuracy over time. However, rebalancing forces you to buy low and sell high. So when we rebalance, we're selling an investment that's increased as a percentage of the portfolio. Generally, it's increased in value. We realize the gain, we take that gain, and we buy more of an investment that's either decreased in value as a percentage of the portfolio, or it just hasn't kept up with growth. So we're selling high and we're buying low, and we're doing it in a structured way that doesn't require us to time the market because we do it annually. Now, because we're recognizing gains during these rebalances, it's important to execute that strategy in conjunction with tax loss harvesting in order to mitigate any tax impact. So the next slide is tax loss harvesting. And this is a strategy where we sell an investment that's temporarily declined, and we do that in order to take a current capital loss on this year's tax return. And so you can deduct $3,000 of capital losses against ordinary income after offsetting other capital gains. But when you do this, make sure that you don't run afoul of the IRS's wash loss rules. So you need to wait at least 30 days to repurchase that same investment, or you can buy a new investment that's not substantially identical as the one you just sold. Okay, next. Lastly, I want to cover tax efficient investing by managing your asset location. So we just talked about asset allocation, the mix between stocks, bonds, and investing that make up your portfolio. Asset location deals with the type of accounts in which those assets are located. So by effectively managing that location, you can improve your investment's total after-tax rate of return by reducing the amount of taxes that you pay. There are three basic asset locations. You have taxable accounts, tax-deferred accounts, and tax-free accounts. A taxable account the income is taxable when it's received. So for this location, you want to consider holding investments that produce tax-free income, such as municipal bonds, or income with preferential tax rates, like qualified dividends from certain U.S. equities, or investments held for long-term capital gains. Also, you want to consider using exchange-traded funds versus mutual funds within this account, because mutual funds buy and sell within the fund that causes a taxable capital gain distribution. ETFs also buy and sell within the fund, but due to their special tax status, no capital gain gets reported. Next, we have tax-deferred accounts, and so these would be your 401ks, 403bs, IRAs, and the like. Now, these are pre-tax accounts that are subject to ordinary income tax on withdrawal. So for this location, consider investments that produce ordinary income. So these would be bonds, bond funds, real estate investment trusts that produce rents, royalties, foreign and U.S. companies paying non-qualified dividends, and short-term capital gains. And mutual funds are okay here, since capital gains distributions aren't being taxable in the year you're being distributed. So finally, we have tax-free accounts, and these are your Roth IRAs and your Roth 401ks. These use after-tax dollars, and the subsequent earnings and growth and distributions of from that account are entirely tax-free. So for this location, consider investments that produce the highest taxable income, or investments that have significant long-term appreciation. You'll avoid paying any and all federal income taxes on these investments in the future. Now, if you'd like help developing a personal financial plan with a tax-efficient investment strategy, please contact us. This is what we do for our clients, and we love to do it for you too. And so now I want to thank you for your time, and I want to pass it off to Amanda Wilhelm to talk more about taxes.
Thank you, Chris. Thank you all again for joining us today. We really appreciate it. So we're going to spend the next few minutes going over some basic tax planning. Chris covered quite a bit in his slides, particularly efficient planning within your portfolio. So I want to go over some other planning ideas you may want to think about as we go into year end. Just to preface, while we need to use the current law for our planning, we should be aware of what could be coming our way as far as tax increases. I have to say it makes 2020 year-end planning just a bit more difficult, but everything else in 2020 has been a bit of a cluster, so why not this too, right? Tried and true year-end planning has always been the mantra of, defer income and accelerate deductions, but the prospect of increased tax rates can leave many of us wondering if really that's the best course of action. Recognizing some income now at known lower rates and kicking some deductions forward could mean more in tax savings in the future. I've noted some planning thoughts surrounding potential changes, but before I touch on them, I want to say that now more than ever, it's imperative that you pair your tax planning with your overall financial planning. Most of the items I'm going to touch on and those that Chris discussed all involve considering both the tax and investment impact. Our teams here at SC&H, is what we do every day. We consider all of these issues and then apply them in a customized fashion for each of our clients so that each decision that we make, it's both tax and investment planning has been considered. So what are we thinking about for clients? We're looking at portfolios and converting ordinary investment income like interest into qualified income. For some of our clients, we're actually generating capital gains now to take advantage of those lower rates still in place for capital. Multi-year planning. Chris discussed Roth conversions, which is a very popular tool to think about when it comes to filling up those lower buckets or thinking about negotiating that bonus or payout into the current year. You can lock in the lower income and actually FICA tax rates, which is another thing that could potentially change. Finally, for the married folks out there, always review and compare the impact of your filing status and take advantage of that reduced marriage penalty. We head to our next slide. Some things to keep in mind for our business owners. As you know, like now, we still have the benefit of the QBI, or what is known as the Qualified Business Income Deduction. I'm sure by this point, most of you are very familiar with the mechanics of this deduction, so I won't go into the details. If you're an SSTB, what is known as a specified service trade or business, you want to make sure you're keeping taxable income below those 2020 limits that we have outlined. Each year, it makes sense, review your wages, assets, even your choice of entity to make sure you're in the best position to get the most out of this deduction. It could also be another part of the tax code that goes away sooner rather than later. I believe that was another one that's on the list. We wrap up our income tax planning discussion. Some of our tried and true tips may still be the best route for you to consider for 2020. Depending on your circumstances, you may want that bonus to be deferred to next year. Always keep an eye on the level of your passive income and losses that are being generated year over year. See what you can do to generate what is needed to absorb passive income or release those built up losses. Finally, at a minimum, take a look at your withholding. Are you on track to have paid in enough to avoid those annoying underpayment penalties? If so, if you're not, think look at where you might be. Reach out to your employer now for a last minute tweak on your wage withholding. Most of us have a couple pays left between now and year end, so that opportunity is there. Now we're going to head into the next slide and talk about some itemized deductions. Good old bunching strategy. Tax reform made this very popular, and again, under the current law, which is what we have to plan with, it's still a great tool to consider. Most of us no longer need to worry about tracking and itemizing our deductions, but in those higher income years, focus on the timing of when you make that charitable donation or the elective surgeries, medical needs. Do you look and try to push it to a year when income is higher or when your collective deductions, they just far outweigh the standard deduction? Another curveball for us, the Biden proposal, they're looking to cap itemized deductions to a 28% tax benefit for those who earn more than $400,000. We have to keep an eye on that potential change as we look to 2021 and future planning. A minor item, but something to think about, the state and local tax deduction. We always want to step back and consider whether you should deduct real estate taxes and sales tax instead of the state income tax to hit that $10,000 cap. Just remember, if you deduct the income tax from Schedule A, you'll be adding that back on your state return again, so that may hit you as far as when you think about the impact and planning on the state tax side. Next on itemized deductions, let's review some options that we have pertaining to charitable giving. Quick update for 2020, the 2020 CARES Act, it contains some beneficial charitable provisions. The main one enabling taxpayers to deduct to 100% of your AGI cash gifts you give directly to charity. To reiterate, this must be cash directly to a public charity, so no donor advised funds or private foundations. It's still a nice bump from that 60% limit. Now, with that being said, when looking to make a charitable contribution, it's always more tax efficient to donate highly appreciated securities as opposed to just cash. When you use appreciated stock, you not only fund your giving and create a deduction, but you're also saving on the tax on that gain, and that would have been realized if you would just if you had held that stock and then sold it, you would have realized that. So you definitely want to think about that strategy because you could save the income tax now and the capital gain tax later. The 2020 RMD suspension that Chris discussed a bit earlier, it puts a damper on this next one that I have in mind, but just still keep in mind even for future years, and that's a qualified charitable distribution. Quick recap, distributions are made directly to charities. Under this plan, your RMD, it's made directly from the plan to the charity. So while you don't take the charitable deduction, the bigger saving is not having to include the RMD in your gross income, which typically results in tax savings. So for now, this provision, it is permanent, I'll put that in quotes, so hopefully it'll be around for a little while for us to use. One other item to think about, don't forget about the Maryland CITC program, the Community Investment Program, that allows taxpayers, both individuals and businesses, to make a charitable contribution to participating charities. So when you do this, you're able to take a federal and state charitable deduction while also taking a Maryland income tax credit for 1/2 of the contribution. The federal deduction, it's limited to the excess of the Maryland credit. It's what the IRS calls the quid pro quo rule. But it's still a nice tax tool to consider. I definitely recommend checking out the website and the process on that. Mortgage interest. So let's talk about that one. So given the current real estate market, our discussion surrounding itemized deductions, all that, it's good to make sure you fully understand the current deduction limitations in place, especially if you're looking to purchase a home. And then reviewing what, if any, tax benefit you're receiving from your current mortgage. $750,000 is the current limit on home acquisition debt. So if you're taking on a new mortgage and that exceeds that magic number I just mentioned, and or if you have home equity loan that was used for anything besides buying or improving your current home, you're going to be limited on what you deduct. So you want to keep that in mind. So as we've advised many of our clients since 2018 and will continue to point out, is maybe you should consider accelerating the pay down of your current mortgage. I believe this should be considered by those who are no longer itemizing, maybe don't have the most favorable of rates, and have enough savings for all of their other financial goals. This isn't just a pure tax answer here, but something you should consider with your financial advisor, as it could be helpful. Also, not tax related, but given current tax rates, a refi could be a really good move to consider too. And that's outside of tax, just thinking about where you might want to go with that. Wrapping up with itemized deductions on our next slide. The last point here we want to talk about is the loss of miscellaneous itemized deductions. And again, I know we're in year 3 of these new rules, but you'd be surprised at the number of individuals who still believe they can deduct those miscellaneous items, those unreimbursed employee business expenses, the professional fees, we're talking legal, tax, investment advisory. These all to be the ones that seem to be causing the most frustration. But again, for those tax and legal fees, we continue to look to make sure those expenses are being correctly applied to self-employment income, rental income, income from other business entities, so that we don't lose out on these deductions. One last little tip to think about is, consider paying your investment advisory fees from your IRA. We brought this up last year. In the past, the plan was pretty opposite. You wanted to pay it from your taxable account to get that deduction. But under the current plan and looking forward, this may be a strategy you want to think about with your advisor. To our next polling question. So true or false, highly appreciated securities are an ideal candidate for charitable giving. True or false? And I would hope that most of you said true. Is that what we just discussed? Jen, I think we can move on to the next slide. So let's talk about some other miscellaneous items as we wrap up our federal discussion here. So let's not forget about our 529 college savings plans and how they fit into your overall planning. Not only does a 529 plan provide, you have your federal tax-free growth and tax-free withdrawals if you use it for those qualified education expenses, but most states, they offer some type of deduction or credit for contributions to their particular state plan. And there's even some states out there that allow you to deduct contributions to any plan. So it's really something to keep in mind as you start looking to saving for little Timmy or little Sally's college plan. That's going to be a big bill. So this is something to think about. So finally, make sure you're taking full advantage of any health savings accounts. We're talking health savings accounts, flexible spending accounts, dependent care, FSAs. This is the time of year, many of us are going through open enrollment right now for benefits, and the option to contribute to an FSA may be available to you. So if your company offers a cafeteria plan that allows you to put away those pre-tax dollars to a flexible spending or dependent care account, be sure to think about it. Now remember, there's use it or lose it plans. What I'm talking about with the flexible spending and the dependent care. But the cost of childcare, the need for new glasses, braces, things that would be covered by these plans, you name it. It's nice to be able to put that money away pre-tax and be able to utilize it. Now let's do a little bit of chatting about where we are on the Maryland side of things on our next slide. I believe the bulk of our webinar participants are in Maryland, so I'm going to touch on where things stand here at home. Maryland continues to follow the 2018 tax reform. A few modifications. We still have personal exemptions in place. Phase outs of these are still around as well. So if your income exceeds $150,000, there's no exemption. The 2020 CARES Act, Maryland has decoupled from some provisions in there too. They may be touched on the business side of things, but just keep that in the back of your mind. 2020, there'll be a slight increase to the standard deduction, which I outlined. Again, they continue to disallow the QBI deduction as they have in the past, and they'll continue to decouple from bonus in Section 179 depreciation. Also to note, Maryland's estate tax exemption, still about $5 million. We've talked about that before, so keep that in mind. when you think about estate planning, which we'll touch on at the end of this portion of the presentation. Last but not least, to the next slide, as we wrap up with Maryland, I just wanted to share a summary of the local tax rate increases. There are quite a few of them for 2020. Our Baltimore County friends, you're up to 3.2% now. So factor that in when you're projecting out your state tax bill. That now gets us to our next polling question. True or false? 529 plans are eligible for a federal tax deduction. I like true or false. True or false? You have a 50-50 shot. Hopefully we get 100% on this one. I think that's enough time there. Hopefully everyone said true. All right. That leads us then into talking about some estate and gift tax planning. So to wrap up this portion, I wanted to do a brief overview of our current estate and gift tax planning considerations. If you were able to join us for our mid-year tax planning webinar, we had a much deeper discussion around estate and gift tax planning. While we don't have as much time to do that today, I do want to share a recap with you and throw out some things to consider as you are reviewing your overall estate plan. Summary, we still have a federal estate and gift tax regime in place. 2018 tax reform doubled the gift and estate tax exemption or lifetime exemption to $10 million per person. And with inflation adjustments, that brings it about to about $11.5 million for 2020. So one can gift up to this amount to anyone without paying any gift tax during their lifetime, and any amount left over, you can use that to reduce your estate tax in that. The current exemption is it's set to expire at the end of 2025, or you want to say, is it? We don't know. The Biden tax plan, if that goes through, would do a major overhaul to this current law. Exemptions would be reduced to about $3.5 million a person. Tax rates would increase. The basis step up at death would be eliminated. So going after these favorable exemptions, it's a pretty easy target. It's an easy part of the code to modify. Mr. Biden's already made comments about that. So many individuals right now, they're looking to do gifting and revising their estate plans to take advantage of these higher exemption amounts. Especially the IRS came out a few months ago and said that there would be no clawback to the exemption if it's reduced at a later date, meaning if anything was put in place, they wouldn't retroactively impact what you did under these higher exemptions. So thinking about that, so what can we consider? Again, as we discussed in our mid-year seminar, we have a really unique combination on our hands for 2020. You have businesses who have decreased asset values, but a high probability of a strong rebound. You have crazy low federal interest rates, and an historically large, but possibly short-lived estate and gift tax exemptions. So you mix all this together, you have a unique climate and honestly, a unique opportunity for estate and gift tax planning. Also some opportunity for charitable planning as well. So as we go to our next slide, very quick summary of some opportunities to consider. Outright gifts. Yes, it's as simple as it sounds. Consider this outright gifts to family and friends. Each of us, we can gift up to $15,000 to any unlimited number of individuals each year and not pay $1 of gift tax. So parents, grandparents, if you're helping out the kids or grandkids with their education, private school, college, unfortunately, if you're assisting with medical bills, write those checks directly to the school or medical facility. They're not considered gifts if you pay directly to the institution, so you're not using your annual exclusion or your lifetime exemption. Also consider gifting to trust. What I have noted here is not the end-all be-all, and I don't have time to get into the technical weeds of what I have listed, but I believe these are the top ones that you should definitely consider. All three of these trusts allow an individual to utilize the higher exemptions now to remove the future value from their estates while still providing that benefit for themselves or their families. So having that asset protection in the case the charitable lead trust, you might actually be able to have an income tax deduction now. Again, the depressed asset values, hefty exemptions, low interest rates, all of this creates a perfect storm, you might say, for doing some involved but potentially very powerful gift and estate planning. Of course, with all these tips we're discussing, there is no one-size-fits-all plan. Definitely discuss this with your advisor, your attorney before pulling the trigger. You know, there's a lot of moving parts. So as always, I know we've thrown a lot of information your way. I truly hope it was informative, and you know, don't hesitate to reach out to any member of our team, as you know, we're here to help. I believe that wraps up our individual portion. Running a little short on time, so you know, please submit your questions and we'll circle back to you directly to answer them.